Hi, I'm Ilya Zlotnick, advisor and partner with Vivaldi Capital Management, and welcome to a direct indexing edition of the Vivaldi Video Podcast. Today I have Bob Holdreth joining us. Bob is the founder of Custom Harvest, a pioneer in direct indexing using ETFs, and a firm recently acquired by Prudential Global Investment Management, where now he heads up the direct indexing group. Bob, thanks for joining us today.
Thanks, Ilya. Good to see you.
You as well. So I'm excited for this conversation. You and I have been working together for seems like a number of years, with you helping our clients allocate to direct indexing as part of their overall asset allocation. And it's a space that's garnered a tremendous amount of interest as of late. It's becoming more and more popular amongst investors and advisors. I suspect that trend's going to continue into the future. One thing that I find interesting is direct indexing has been around for many decades. Initially with using individual stocks, which we'll talk about, and really for much higher net worth, larger accounts. Now with technology becoming ubiquitous in all aspects of our financial lives, minimums really don't matter, and everybody has access to direct indexing. Yet I suspect there are still many investors out there who are less familiar with the space. So if somebody comes to you and says, what is direct indexing? And how does it provide value to my portfolio? How do you answer that?
Yeah, basically direct indexing is an individual account. So you have your own tax bases and cost bases in your securities, but the goal is to provide the return of an index or a strategy. And the index usually is the S&P 500, MSCI, All Cap World, et cetera.
Nice, great. And then, given your background, you've been in the financial services industry for a while. I know you've had experience with other areas of it and starting companies. How did you initially get into financial services? What was kind of that story? And then what led you to direct indexing?
Sure. So I was financial services is my second career. I was involved in outdoor sports, sporting goods, mountain biking, a bunch of other sports for first kind of 20 years of my adult life. I was asked to join as a financial advisor in the now defunct PaineWebber, which became UBS back in the 90s. So that's how I kind of made my way into here. Started as a financial advisor, worked in-house at UBS, and eventually got out to the field. And as you said, left and started my own firm. So I've always been a fan of indexing. And the easiest way to get index exposure forever has always been to buy ETFs. So before ETFs became popular in the late 90s and early 2000s, I was involved in the use of ETFs, mostly modeling ETFs to get exposure for clients that was cost efficient and tax efficient. Direct indexing is kind of the next derivative of that. I think it's popular because indexing is popular, because there are a lot of clients out there that believe that not taking any more risk than the index risk and only getting the return of the index on a fairly consistent basis is a good thing, is a good investment strategy. And the need to reach for additional alpha is not always necessary, especially if it takes additional risk. So when I had a job at UBS many years ago, we had a couple of direct indexing strategies on our platform. And I repped them, I sold them, if you will, to clients and advisors back in the early to mid 2000s. That was my first introduction to direct indexing.
And then, okay, so that was kind of the first part of your career in financial services, doing kind of what I do, right? Being an advisor, working with clients. And then what led you eventually to start Custom Harvest? Kind of what was that transition? Why did you? And then maybe talk about how your approach to direct indexing is different than what's out there, right? Most direct indexers focus on individual stocks. You decided to focus on ETFs. So I'm curious to hear about how you decided to take that approach. Then I call it the non-traditional direct indexing approach.
Yeah, so direct indexing is about indexing, but it's also about taxes. And as people earn more and more money, as baby boomers start to retire and reallocate assets, and as tax rates go up, indexing with that additional benefit, I think, is why direct indexing has gotten so popular and really what led me to it. When you get involved in any new company, It seems obvious to say, but you want to be involved in a growthy part of the industry. There are some parts of the industry that are shrinking, some that are clearly growing. Direct indexing is one of the faster growing industries right now. So having been involved in ETFs, as I said early on at Payne Weber at UBS, having my own ETF company for 8 years, I wanted to take the next step and actually be an implementer using other folks' ETFs. And as I said, those kind of 3 trends that have come together in the last 5 or 10 years that make direct indexing interesting and valuable to clients is something that became attractive to me. I've always been a fan of ETFs, as I said, and when I see a strategy that I think has value and I think might make sense for clients, the first question I always ask myself is, hey, I wonder if you could do that with ETFs. I wonder if it would make at least as much sense. And my view has been that if you can replicate a 500 stock strategy with 11 securities instead of 100 or 300 or 500 securities, there's some great value in simplicity as well. It's easier for everybody to understand all the way up and down the food chain, from the client to the advisor, down to the portfolio manager. So that's really why I think the ETF strategy makes a lot of sense.
Yeah. Well, there's a few things I think to highlight when it comes to direct indexing. One of them is, with active management, there's no guarantee that you're going to outperform the index. You're typically paying a higher fee. There tends to be more cash drag or tax drag when you're doing it, obviously, in a taxable account. So you have these headwinds, so to speak. Whereas with what you're doing and my methodology or philosophy when I talk to clients or allocate to portfolios is this is going to be a part of the portfolio that's going to mimic the index. So there'll be what you call low tracking error. But you're almost guaranteed over a period of time what they call tax alpha, right? The ability to harvest these losses and through that to be able to generate a higher after-tax return, which is one of the really the compelling parts of direct indexing approach. Now, what I found through conversations with you and actually seeing this in implementation is the difference between using individual stocks and ETFs actually has some incremental benefits. So maybe we could talk about that and maybe highlight last year as an example where you really saw, the work that you do come into play very much so versus maybe years past where there was less volatility. So talk about those differences in the actual implementation and the results that it delivers for clients.
Sure. So let me touch on active versus passive for a second. So we kind of have no position there. We think there's room for active and passive management, usually in most clients' portfolios. We think active managers are seeking opportunity and passive managers are seeking consistency. So depending on what the client and advisor are looking for, what's more important to them, they may decide to choose one or the other, or more likely both of those. So as far as direct indexing goes, I mentioned that the benefit of direct indexing versus just a traditional ETF-based indexing is that there's a second opportunity offered. So the opportunity with indexing, as we've been saying, is to capture about the return of the market, give or take costs and slippage, et cetera. The other opportunity with direct indexing is the ability to realize unrealized losses. And that, in fact, is what loss harvesting is all about. So when I was an advisor back in the 90s and interest rates would go up or down over time, there were always, or seemed like there were always opportunities to realize losses, to tax loss harvest municipal bonds. And occasionally there are opportunities to do that with individual securities as well. So the concept of having a separate account with one client tax ID and being able to capture losses is certainly not new at all. It's been around for quite a while. So the question is, if an opportunity exists, and you brought up 2022, a January investor in 2022 certainly saw a lot of downside, which translates to, for a loss harvesting manager, a lot of opportunity. And the ability to realize those unrealized losses is equally important, I believe, versus just sitting on the index. So over time, historically, the ability to turn the whole portfolio over, which sometimes you can do with ETFs, and the inability to do that, which sometimes you cannot do with individual equities, can help you realize more of the unrealized. And I would argue that during years like 2022, or in the first quarter of 2020, or Q4 2018, those are the moments when clients' expectations for a direct indexer to capture losses are the highest. And those are the moments I believe that matter the most if you're trying to capture losses. So just to kind of summarize that thought, a manager who has the ability to turn his or her portfolio over 100% in some 30, 60-day period of time has at least the opportunity or the chance to capture close to 100% of the downside. And a manager who does not have the ability to do that limits their ability to capture losses by whatever percentage they can turn the account over.
Yeah, well, especially in years like 2022, when markets go down, there's a lot of volatility. So when they go down, they might not stay down for very long. So you have to really be very precise when you capture those losses and have the flexibility to do it multiple times within that 31-day wash sale period. Because if you do it too early and you lose your ability to do it, then you're kind of stuck as markets continue to go down, then bounce back up. Ultimately is what I saw happen in 2022. And to kind of bring it to life, from my perspective, when I sit down with clients and view their strategy, I see this really playing a role in several situations. So for example, I had a client sell their business in 2021. We implemented a part of their allocation into custom harvest. I think we started with something like 35% and worked our way up to 45% as a part of their overall portfolio. So since they sold their business, they had a lot of gains to be able that we could offset. And what was good for their situation is that their gains happened in 2 years. So they had their initial sale, and then they had kind of this what I could call an earnout period, where they got paid out again the following year. And because there were so many losses to accrue last year, they were effectively able to offset all of their capital gains in 2022 from the sale of their business. So that was really interesting. The other is because we do use a mix of passive strategies like the custom harvests of the world with active, because we have a research team and their job is to find managers within typically private markets that have the ability to generate outsized returns. Those tend to be at certain times more tax inefficient strategies because there's more activity. So by using a strategy that creates losses, we're able to offset the gains that are created in the more actively managed part of the portfolio, effectively increasing our after-tax return, which is what we're talking about.
Yeah, and I think it's again, we don't give tax advice, and neither do you, but it's a pretty safe bet. It's common knowledge that there are many capital gains out there outside of the capital gains that are created within an equity portfolio, a stock portfolio, or a bond portfolio, that can be offset with losses that are created by a direct indexer. So some real estate transactions, some business transactions, et cetera, can be offset. So although the losses are not a universal tool, they're a tool that can be applied to many, many other types of capital gains. And we've seen many of our clients do that over the years. And you make an interesting point, right? So there are a couple of years. So if you know capital gains are coming under current federal tax law, you can carry losses forward as well. So you can actually plan towards that sale, assuming that there's opportunity and the direct indexing manager has the ability to turn those opportunities into realized losses. You may be able to offset some of the anticipated capital gains 2 years, 3 years, 4 years down the road, at least under current federal tax laws. So direct indexing and loss harvesting clearly are part of a much broader strategy. than just a strategy that lives within the client's portfolio.
That's right. And that's what kind of makes my job so interesting and so dynamic is I have all these different tools at my disposal and figuring out how to use which ones when, and then be able to obviously plan for the future as well. The other comment that I wanted to make is that I've noticed is, and you kind of alluded to this earlier, but the fact that, you have multiple strategies, right? You have a domestic strategy. Well, maybe you could spend a few moments talking about the different types of strategies that a client could use when building a portfolio.
Sure. So most direct indexing managers offer a U.S. strategy. Some offer a global strategy as well. And if you can do global and U.S., then you can obviously also do international. Any ETFs that are available that have multiple exposures, and so what most ETF-based direct indexers do is they exchange or swap one ETF for another, and that solves the how do I stay invested and still capture a loss issue. You could do that with municipal bonds as well as we do. You may be able to do that with Bitcoin-based ETFs or small cap or a specific country. So any exposure that you can buy times 2 with ETFs permits you to get exposure to asset classes outside just U.S. equities. Our business is heavily weighted towards U.S. and global equity, and I think most direct indexing managers would tell you the same thing.
Yeah, I've been using your global ETF strategy, equity ETF strategy. I believe there's 20 or so ETFs, half of which are domestic, half of which are international. I find the simplicity of that appealing, to see that there's 20 line items, knowing that if a client invests today, that at some point that the amount of tax losses that you could generate starts to go down to zero, effectively maybe turns into zero if there's not fresh cost basis added, because markets tend to go up over time. So being left with 20 ETFs that mimic a market versus maybe 300, 400, if you're doing individual stocks, to me is an appealing planning tool as well, long-term, as I look at that. And then I guess as you look at the future, you've talked to me about tinkering with different ideas and strategies. What do you see as the future of the work that you do, or any cool projects that you might be working on that could be available to advisors or clients in the future to consider?
Yeah, so again, back to the ETFs are great Swiss Army knife, somebody called them a long time ago, right? They're a multifaceted tool that can be used in a lot of different ways. And in my case, a product developer's imagination is the only limit to perhaps what you would be allowed to create. So for a long time, there was a market site where clearly growth in U.S. were dominant. And a lot of the largest names, the largest market cap names, drove the market return. So if you did not want to have exposure to growth, clearly a value-based portfolio can be created based on a value benchmark. And both S&P, Russell, MSCI, all three of those index providers offer those benchmarks as models. And clearly, it would be relatively easy to create a model that's value-based. If you believe that large cap names or mega cap names would no longer take a leadership role in U.S. equity markets, the opportunity to equal weight also is out there. So that's another possibility as well. Owning equal weights in sectors instead of having a huge overweight to technology and a big underweight to real estate, consumer staples, et cetera, is another possibility that's out there. Another possibility is to tilt away from the MSCI All Cap World Current Weights, which are about 60-40. If an investor or an advisor wanted to be greater weighted toward outside the US and wanted a 50-50 weight, for example, that's something that could be achieved as well. So I think reweighting of current strategies to provide an exposure, to provide your outlook, are probably some of the most innovative things that are going on. Using ETFs usually makes that a lot easier to do, if not possible to do, or really would be impossible to do any of that with individual equities.
Yeah, and obviously with the proliferation of the ETF space, which continues, you have more and more tools at your disposal with ETFs that have the right amount of assets, liquidity, volume, all that kind of stuff for it to be a viable in a way where you could continue to grow the business and have that available for lots of different clients.
Yeah, absolutely. And the historically, the number of ETFs has continued to go up. And as there is more competition in any space, in any market, historically, pricing has tended to come down. So the trend for an ETF strategist and for clients that use ETF strategists has been beneficial on both fronts, more variety and effectively lower cost.
Great. Well, is there any other thoughts or anything that you feel like we've missed talking about the work that you do that's worth sharing with the folks that are listening?
I would say that what's nice about for investors in any industry is when more product providers enter a space, you have pricing competition, which is a benefit for investors, and you also have choice. So before we came out with the Green Harvest strategy about 6 years ago, there were mostly individual equity opportunities. There was some variance and differentiation in their offerings, but our strategy is different yet again. So there's a lot of choices out there, and it behooves an investor and advisor, of course, to dig deep and look at costs and look at what the outcomes have been for managers, especially during downturns. And I think that'll help sway you as to which manager makes the most sense for you.
That's right. Well, I know all about choice and the opportunities out there. You know, I'm constantly getting emails and outreach from other providers to talk about what they have and why it's unique. So it's a good spot to be in to really figure out what we think is best for clients. So I enjoy that role. And as I mentioned when we first started, the space continues to grow. Obviously, taxes is an area where clients will always want to reduce their exposure to. So there'll always be kind of the role of this. So I look forward to continuing to work with you and your team. And it's a pleasure to chat with you today.
My pleasure, Leah. Thank you so much for your time.
All right. Have a great day.
You too. Thanks.